everyone, welcome to my channel Real Time Economics. Today in the first part of the video, we'll focus on the knowledge section where we do a deep dive into the reasons leading to a plunge in the rupee value compared to the dollar. Secondly, we are going to see how is this fall different from the taper tantrum which was witnessed in 2013. In the second part, we are going to move to the application where we'll try to analyze the impact of rupee on various essential macroeconomic parameters. So let's get started. Rupee declined to 95 rupees per dollar, an all-time closing low on March 31st. Weighed down by concerns arising from high crude oil prices, which is due to the war in West Asia, the foreign capital outflows, which were the highest of $16.4 billion in 28 years. Also, the geopolitical uncertainties, which has increased the demand for safe haven, that is dollar. The point to note here is that the rupee has declined around 10% in the financial year 26, recording the worst performance since the financial year 2012 when the taper tantrum had happened. And much of this decline came during the pre-war period. So let us look at the several reasons which led to the rupee weak performance in the entire financial year of 2026. The first and foremost is the change in the RBI strategy from aggressive defense towards a calibrated depreciation approach. The massive capital outflows due to the concerns over high tariffs, the premium company valuations, their muted earnings, and also the other emerging markets being attractive in terms of their valuations. Another factor we can say is the widening trade deficit, which has also contributed to the depreciation of the currency. As you can see on this chart, the majority of the depreciation of the rupee happened between 2012 to 2014 when it depreciated by over 30% in these 3 years. Fast forward to 2025-26, we have witnessed a 10% depreciation so far, with the majority of it coming before the pre-war period, that is before February 28. On February 28, the West Asian War began, and after that, the rupee has depreciated by around 3%. So this short depreciation in the rupee in 2026 has brought back the memories of the taper tantrum era of 2013. So for those of you who do not know what this taper tantrum is, let me give you a quick primer on it. In the taper tantrum, there was a sudden market panic that occurred because the US Federal Reserve had signaled that they will reduce their massive bond buying program, and hence they will suck the liquidity out of the system. So whenever the bond buying tapers, it always reduces the bond prices and increases the bond yields. This leads to the investors rapidly pulling out of the money from the emerging markets such as India. Back in 2013, the Indian economy was still recovering from the impact of the 2008-2009 global financial crisis. The rupee was weakening sharply as crude oil prices had consistently been above $100 per barrel. India's foreign exchange reserves were just $300 billion and the current account deficit was 5% of GDP. However, today our foreign exchange reserves remain strong at around $700 billion and the current deficit is also around 1% of GDP. This is until December 2025. So RBI letting the rupee go a bit is a good thing. It is actually needed as a strategy to survive a slightly elongated crisis, because if this is a long drawn out crisis, you will want to preserve your foreign exchange reserves. Because last time when we got into trouble in 2013, our reserves had gone down and then the taper tantrum made it worse. Move on to the second part of the video, wherein we use the demand and supply graphs to further understand the concept of rupee depreciation. When the US war had begun on 28 February 2026, the rupee dollar exchange rate was hovering around 91 rupees per dollar. However, post-war breakout, it reached to a low of 95 rupees per dollar as on March 30th, 2026. So we can see that there has been a 4% decline in rupee post West Asian war crisis. Let us now look at how the market forces of demand and supply determine the price of dollar or rupees. This is a graph showing the market for dollars. On the y-axis we have the price of dollars in terms of rupees per dollar, and we have the quantity of dollars on the x-axis. You can see that the demand for dollars is a negatively sloping curve, showing that the relationship between the price of dollar and the demand for dollar is negative, which means that if the price of dollar increases, or if the exchange rate of rupee per dollar increases from, let's say, 80 rupees per dollar to 90 rupees per dollar, our exports are going to become cheaper, and hence the supply of dollar is going to increase. This is represented by an upward sloping supply curve, which shows a positive relation between price of dollar and supply. On the other hand, our imports will become expensive, and hence the demand for dollar will fall. Therefore, we have a downward sloping demand curve and a upward sloping supply curve. The two are initially meeting at point E. So this point of intersection is the equilibrium in the market. Now, because of the increase in the energy prices and because of the foreign capital outflows, what is happening to the demand for dollars and rupees? Because of high energy prices and foreign capital outflows, there is an increase in the demand for US dollars, and there is at the same time an increase in the supply of rupees. If the energy prices are high, we are going to import more, and hence we will need more dollars. To buy more dollars, we will have to supply rupees in the foreign exchange market, and hence an increase in supply of rupees. Similarly, for foreign capital outflows, if the foreign investors are withdrawing or pulling out their money from India, they will have to convert their rupees into dollars. So this will increase the demand for dollars and increase the supply of rupees. Both of these will lead to a rightward shift of the demand curve. So taking into account that our initial demand curve is D1 and our initial supply curve is S1. Because of these two factors stated above, there is going to be a rightward shift of the demand curve. So what happens as a result of this rightward shift? The new equilibrium shifts to point E1, and you can see that at this point the price of dollar has increased, or the rupee dollar exchange rate has increased. In other words, the rupee has depreciated. The foreign capital outflows has been another reason for rupee depreciation, and we have discussed the reasons for the same. It is because of the geopolitical tensions. There is higher uncertainty, the investors are spooky, and they would like to move their funds to the safe haven assets like US dollar assets. Another factor is the premium valuation of the Indian companies. They are already overvalued, and the investors feel that the other emerging markets are giving them better and attractive valuations. The Indian companies' earnings have been muted for some time. They have not been increasing rapidly. As a result, again, the investors are moving their money out of the Indian companies into the other emerging market companies. There has been a lack of investment in the AI value chain in India, because of which the funds are shifting to the high AI correlation markets like Korea and Taiwan. Current account deficit. To understand what is a current account deficit, let us first define what is included in the current account. So current account includes, or it is equal to, exports of goods and services minus imports of goods and services. So whenever there is a deficit in the current account, it happens because our imports are greater than our exports. So if the crude prices are rising, it leads to higher import bill, which means that our imports are greater than our exports. We need more demand, we need more dollars to pay for these imports, and the current account deficit widens. This leads to a downward pressure on rupee. Since the demand for dollars increase, as we saw in the previous graph, the demand curve is going to shift to the right and lead to a depreciation of the rupee. Next is speculation and expectations. Breaking rupees 92.5 level triggered a sharp sell-off. The traders expect that further depreciation would be there, and hence this led to a speculative selling of rupee. Let's try to understand this in a little more detail. So what happens is, if the traders are expecting that the rupee will further fall from 92 per dollar to, let's say, 95 per dollar. So earlier, if they were holding $1, they were getting 92. If they will buy more dollars, they will be able to exchange it for 95 rupees. Hence, they are going to demand more dollars. This would lead to more buying of dollars in the foreign exchange market. For that, they will have to sell rupees in the foreign exchange market, leading to an excess supply of rupees in the foreign exchange market, and hence the depreciation of the rupee. Next is the elasticity approach, the Marshall-Lerner condition. The Marshall-Lerner condition says that if you want to benefit, or if you want your current account deficit to decrease or your current account to improve, the devaluation will lead to this outcome only if the price elasticity of demand for exports plus imports is greater than 1. However, we know in the short run, the elasticity of demand for both exports and imports is inelastic. As a result, the current account balance will first deteriorate before it starts to improve in the long run. We call it the J-curve effect. So in the short run, if there is a decrease in price of exports, it will cause only a smaller percentage rise in the quantity demanded of our exports. Similarly, if there is an increase in price of imports, it will just cause a smaller percentage fall in demand for our imports. So the demand for exports and imports being inelastic, we will actually see a worsening of current account deficit before it gets better in the long run. So let us once again summarize the key factors behind the rupee decline. The first and foremost that we have discussed was the massive capital outflows due to concerns over high tariffs, valuations, and also because of the geopolitical uncertainty. Change in RBI's strategy from aggressive defense towards a calibrated depreciation approach. the widening trade deficit, and the high gold imports. These are the key factors which have led to a decline in the rupee in the financial year 2026. The West Asian War started post 28 February 2026 and has added fuel to the fire and accelerated this decline in the rupee. Thank you for watching. If you like the content, please do not forget to like, share and subscribe.